Okay, so welcome back to the desk. What we're going to do now is move on from the idea generation phase to the gatekeeping process. The gatekeeping process is a really important step, and you have to really get used to the idea of what's in the gatekeeping process and where it fits in to the overall systematic process. And at this stage, what you have to assume now is that you actually have fundamental trade ideas. And when you've got these fundamental trade ideas, we have to move into the next stage, which is attempting to time or cleanse our ideas. So we stop ourselves doing silly or stupid things like putting on good ideas and mistiming them, so these good ideas end up becoming eventually good trades that would have made us a lot of money, but we end up actually trading out in the short term before they become good ideas or good trades because we mistime the trade, or just putting on bad ideas and they just go wrong and you cut and you end up just losing money. So you have to get used to this idea of timing, what we use for timing, and where it sits in the overall process and why we do it. So first of all, we're going to go over to the computer screen and we're going to remind ourselves and go over all the reasons why we actually have a gatekeeping process in the first place, and why and where it sits within the overall process and why. And then we're going to look at our first timing mechanism that we use in the gatekeeping process, the commitment of traders report. In the video after, or in subsequent videos within the gatekeeping process, we're going to be looking at technical analysis and price action. But first we're going to look at commitment of traders reports, which are a fantastic timing indicator when we're trying to time our fundamental predispositions or fundamental trades to get an optimal entry point. So let's go over to the computer screen. Let's go through all the reasons why we have a gatekeeping process in the first place. Let's go through the gatekeeping process as to where it sits within the overall process to understand exactly why all these indicators sit where they do within the overall process and where. And then let's cover commitment of traders reports, and I'll see you at the end of the video for a recap. Okay, so what we're going to do here now is move into the gatekeeping process. So we're looking now to time our fundamental positions. So the idea generation phase provided us with the fundamental predisposition and bias of short Aussie dollar, US dollar, and in the backdrop having an overall inflationary caution on the US dollar. So these fundamental predispositions and our scorecards have to be always updated on a regular basis. Now, please remember, the universe of currency trading is a lot smaller than in stock trading. So overall, in the stock market globally, there's 42,000 opportunities. In that, there's 42,000 tradable instruments or stocks available out there on the planet. With currencies, there's obviously a lot less currency pairs that are tradable and accessible by the retail trader. So there's obviously, on an absolute basis, less opportunities. And within these less opportunities, volatility over every time frame is much lower. So there's less short-term opportunities. So we always have to bear this in mind. We have to also be very, very diligent in the forex markets in avoiding boredom trading, and in particular, avoid day trading just for the sake of day trading. As we've seen throughout the video series, volatility over a one-day basis, especially within the major currency pairs, is very, very low. and there's very little room for error. So it's just not an optimal trading strategy. So unless volatility absolutely goes through the roof on a short-term basis due to some fundamental unexpected move in the forex markets, we just avoid day trading. And it's not a good idea to day trade just because we can get the leverage. Just because we can get the leverage doesn't make a trade a good idea. So what we've got to do is always update our scorecards and be patient. So be diligent and patient. We have to wait for the big moves and look to time them as well as possible. The big moves might only happen a few times a year, but when they come, they're definitely worth waiting for. So what we have to do overall is continue our systematic process in the same way in which we do across all asset classes. So, for example, in the stock market, and how we do it in the PTM video series. So what we'll do now is go through the gatekeeping process and seek to time our trades. We're looking to time our fundamental ideas as generated by the overall idea generation process from endogenous and exogenous analysis, which gives us our fundamental predisposition, and seek to time these fundamental predispositions as well as possible. So how does this all fit in with the overall process? Well, just as a reminder, we've have a look at the overall process here again. If you remember, what we've done is we've got our overall currency views from our idea generation phase, which is the main bulk of our work as traders in the forex market. Probably 80% of your work, 80% of your time is going to be spent generating ideas and updating all of your spreadsheets. 20% of your work and 20% of your time is going to be spent taking your fundamental ideas, your fundamental predispositions as generated by the overall idea generation process, and timing those trades as well as you can. So timing the positions well. And there's three areas that we use for timing. We use the COT or COT reports, the commitment of traders reports, which we'll be looking at in this video. We use technical analysis, and we use price action. So idea generation first, fundamentals, 80%. Timing or gatekeeping, which is made up of COT reports, technical analysis, and price action, is 20% of your time. And what you're really doing here is looking to time your trades better. So fundamentals up here, timing second. And later we move on to risk management, which is again a volatility assessment and overall risk management rules. So that's the third section of our overall professional trader systematic process. Our final area is our self-awareness statistics. So taking the trades that are having been completed. So we have an idea here, timing here, real positions in the portfolio here, and then when we trade out, we have our self-awareness statistics. So trades that have been completed, and here, trades that are open. Now here, in fundamentals, we now have a fundamental bias to one of our currency pairs. And as mentioned previously, at this stage, an idea is just an idea and it's not a trade yet. It's only a trade when we have a position. So now we have a gatekeeping process in order to stop ourselves doing something stupid. So putting an idea on at the wrong time. We want to maximize or optimize our timing on the idea. So bear in mind this whole overall process and keep this in the back of your mind the whole time. So the first thing we need to do is actually understand what a position is likely to look like in our overall portfolio. We're going to come on to risk management and go into a lot more detail on this later, but we need to have a rough understanding of this first so we can get the most out of our gatekeeping process. So when we're looking to time our trades, we understand roughly the position sizing we're going to have and what a position looks like in our overall portfolio. So what we're probably going to be doing here is, as highlighted much earlier on in the video series, is putting a larger amount of capital deposited on margin into our trading accounts than the average retail trader. So the average retail trader who only wants to focus on forex will probably only put $2,000 to $4,000 into their portfolio on margin, and will be maximizing their leverage right to the maximum they can take. So having 50 to 100 times leverage on $2,000 to $4,000 deposited on margin in the portfolio. As highlighted earlier in the video series, this is just one of the main reasons why so many retail traders blow up and blow up quickly. We're not going to do that. We're going to be depositing larger amounts of capital, so we never ever get a margin call. We don't even want to think about getting a margin call. So with $25,000 deposited on margin and a 1 to 2% margin requirement in forex at the brokerage company we choose, if we take a starter position of $50,000 to $100,000 equivalent, what will actually be happening is we'll only be committing $500 to $2,000 of margin to a trade. So we're being offered 50 to 100 times leverage by the broker, but we choose not to take it. We decide our own exposure levels and we deposit more money. We want to beat the brokers at their own game. So we want to use their leverage, but optimize the amount of leverage we use. So by taking a starter position of $50,000 to $100,000 equivalent, we'll only be committing $500 to $2,000 out of the $25,000 of margin to any particular trade, if it's $50,000 to $100,000 overall exposure. So that's 2 to 8% of the total margin that we've deposited in the account. Now, what's a starter position? Well, let's define this. We don't go in as traders and decide, okay, we want to buy or sell something, and we just put on our full size immediately. A starter position is usually anything between 20 to 50% of what your intended final position is going to be. So the $50,000 to $100,000, for example, can be half of what you intend it to be. So your full position size can be $100,000 to $200,000 equivalent. And we add to positions later when they start making money for us. So a starter position is your initial purchase or short of a forex currency pair. And essentially what you're doing is you're just dipping your toe to get a little bit wet. And by doing so, you're in the game. And when the position starts to pay you, you can always add to the position. We don't go in and just buy everything we want to buy immediately on a 1 to 3 month time frame, or short everything we want to be short on a 1 to 3 month time frame. We go in and we start with a small position. So what we've assumed here is that this currency position is in addition to a 4 times exposed stock portfolio of $100,000. So the $25,000 on account multiplied by 4. So you're giving yourself a limit of $100,000 on the stock portion of your portfolio. So what's dedicated to the stock market. So if we have another $50,000 or $100,000 position in forex on top of this, this means the currency pair becomes 33 to 50% of an overall portfolio. So basically the total maximum gross exposure of this portfolio is going to be $200,000. So $100,000 dedicated to the stock portion of the portfolio, plus $100,000 exposure dedicated to the currency portion of the portfolio. So that means if we've deposited $25,000, overall, we're 8 times exposed, and we seek to add to positions as fundamentals and trend are confirmed, and the position becomes a winning position. Now, if we get a 10% move in a currency pair over 1 to 3 months, and that's what we're looking for here on our volatility profiles over this time period, we can basically make $5,000 to $10,000 over the period by committing 1 to 2% margin. So the $500 to the $2,000 as the portion of the margin of $25,000 that we've deposited. The $500 to the $2,000 is the margin that we're utilizing as part of our overall deposited margin that's dedicated to this currency pair. So this gives us a return, a percentage return over that time period of 400 to 900%. And what we've actually done is captured the volatility, but we haven't over levered. So we're trading a lot more sensibly here with our fundamental idea generation process, good timing, and sensible risk management metrics. And what we might even do is, if the trade is looking like after 6, 8 weeks, or even 12 weeks, that it's going to continue going in our favor, we may even add more to the position as we're confirmed to be winning and making even more. So we'll be touching on this a bit later when we look at price action and also in risk management. So we may even add more to this position and continue to keep the position beyond 3 months. So now that we've outlined the kind of position sizing and exposure and risk management we're looking at in the Forex market, we can move on and really get the most out of our gatekeeping phase. Now, just to put it all into context again, gatekeeping, what it is really, is basically you putting a barrier between your ideas as a trader and your real capital. So if you recall, in the risk management phase, that's when we have real positions. In the self-awareness phase, that's where we've been in positions and traded out. So our trades have been completed. At the portion of timing within the overall systematic process, what you're actually doing is putting a barrier between yourself, your ideas as a trader, and your real capital. So before you actually take a real position and commit real money to it. And what you've got to really understand and be aware of here is that human beings are just human beings. After doing a ton of work and fundamental research, every human being always thinks their ideas are great. However, in trading, what you need to do is always have a barrier or head check that stops you from doing stupid things. So putting a fundamentally good idea on and completely mistiming it. So we need this head check for timing, because you can have the best idea in the world, you can mistime it, you can end up having to trade out, so getting stopped out because you're losing too much money. But then the trade might actually go in your favor after you've traded out or been stopped out, and then longer term you're actually proved to be right. So not having any barrier between your ideas and your real capital before you actually go and take a position is one of the silliest things you will do as a retail trader. Professional traders are fully aware that ideas are not trades until they've been cleansed. So it's been checked over and over again that the timing is probably good to actually go into the trade now. So at this stage, what we really want is proof that the market is actually on our side. So we're not actually arguing with the market, we're going with the market and running the fundamental and technical trend. So we don't, however, just want to simply look at weak charts and sell everything on the low and look at strong charts and buy everything on the highs just because a chart is in agreement with us, because this could be detrimental to our timing. So imagine the situation where you have a fundamental predisposition to be short a currency pair, and you pull up a chart and it's gone down for a long time and it looks weak. Well, on the surface, it looks like that the fundamentals are weak and the chart or the technicals are weak as well. But we don't want to just simply go and short everything because the chart looks weak. Just because a chart is in agreement with us doesn't mean the timing is good. What we need to do is strike a balance between having forward-looking original trade ideas that are starting to play out and seek the 1 to 3 month big 10% plus moves. Because if we have a fundamental predisposition to be short and the currency is already down 20 to 25%, this could mean that the trade has already played itself out. So we need to be a bit more sophisticated in our timing here. So what we have to do is do more work. And there's 3 items that we have to consider in the Forex markets when going through the gatekeeping phase. The first one we're going to look at now, which is the commitment of traders reports. What we want to know here is, how is the market lined up? How is the market positioning itself? Secondly, we're going to look at technicals. Does the fundamental idea seem to be playing out? Are we early? Are we late? Are we looking to get into a trend? Is the trend well defined? We need to be asking ourselves all of these questions. And the third one is price action, where we have a process where we run almost an accounting mechanism, and we look at watch lists. So we look at price action as part of our overall accounting mechanism or watch list process. Now, we've talked about these big 1 to 3 month 10% moves here. We need to get an appreciation and understanding of what this looks like in order to get the best out of our gatekeeping process and in terms of our expected timing. So we're going to go through a few examples here. One very good classic recent example, which had the fundamentals on our side and the technicals with what we call a bull flag and breakout in October 2014, November 2014, was the dollar-yen cross. Now, in terms of technicals, we'll be coming onto this a bit later, but it's good to get an understanding of why we're looking at these things. So you can see here from the dollar-yen trade that the dollar-yen cross broke out technically here at a resistance, a previous resistance high of around 110. And then it went very, very quickly to 120 and even above 120 to above 121. So what we got there was the equivalent of a 9 to 10 point move very, very quickly. So from end of October, beginning of November to January, and it's gone sideways since. So you can see here, this is a very, very good example of a currency pair moving around 8% very, very quickly And if we'd have actually managed to have a starter position here and then added to our position once it had broken out to our full position size, we would have actually potentially made even more. So that's a very, very good example of a 10% move as well in a currency pair. Another recent classic example is the euro-dollar cross, where we had fundamentals and technicals with multiple breakdowns. So we're looking, for example, on the breakdown here, if we have a fundamental predisposition to be short, to start getting short in the low 130s. And euro-dollar ended up falling all the way down to as low as around 105. So we had potentially a 30-point move in euro-dollar to capture in as little as 3 to 4 months. That was a huge and very predictable move. And we had multiple breakdowns. We had the breakdown at around 135. We had the breakdown at around 133. We had a breakdown at around 131. And we had a breakdown, a major breakdown here at 128. And we could have had starter position and added to our position all the way and just kept getting bigger and bigger and bigger. So this is a classic example of a currency pair where we could have had a 20% move and made 20% in 3 to 4 months. That was huge. Even if we look at currency pairs that are not massively traded at all by the retail trader market, when we even look at currency pairs like Norwegian krona, Swedish krona, this was again a classic and fundamental plus technical weekly setup, because we had the oil price sell-off towards the end of 2014, and you can see here that we had in Norwegian krona, because Norway is very heavily dependent on oil, a move from around 113 down as far even as 97, 98 on the currency pair. So again, we have a big move of a magnitude of 12% plus to capture here with very defined technical breakdowns. So starter position, then adding to the position later. So we can get an appreciation here and understanding of what we're looking at and why we're looking at it. Now, a great place to start for our gatekeeping process and using tools in order to gain an advantage in terms of timing is to start with the commitment of traders, or COT reports. So they're a really good place to start in building an appreciation for timing on your fundamentally driven trade idea. And please do not get this upside down. Do not get this process the wrong way round. We do not look at COT reports to actually generate an idea and then look for all the reasons afterwards why we want to be long or why we want to be short. What you need to be doing is going through the systematic process as professional traders would do so, and gaining your fundamental predisposition first. And COT reports are one of our tools for timing a trade optimally. Now, COT reports are available weekly on a Friday from the CFTC, the Commodities Futures Trading Commission website. And the links are available in the spreadsheet download section to enable to obtain all the historical data for the financial futures. So we'll be going over to our spreadsheets in a moment from the download section, but these are the links that you'll need to go and get the CFTC reports. So what's included is mostly financial futures contracts traded on the CME, ICE, and CBOT. And the currency futures that we're interested in are all traded on the CME. Now, one word of warning here, not all of our tradable set is available as a financial futures contract on the CME. So if the currency pair is not available, then you just have to jump directly to the step number 2 and 3 of the gatekeeping process, so technical analysis and price action. Now, when you first go to the CFTC website, you're going to see when you download the COT reports that there's a huge amount of data, and also the data can be very confusing. But what we've done is put together a few shortcuts for you to show you where to look and how to interpret everything correctly. So we'll be going over to the spreadsheet in a moment, but first let's qualify what we really need to look for. What's really going to help us in terms of gauging our timing within our own gatekeeping process when we look at commitment of traders reports? Well, the information that you need to focus on is non-commercial activity. Historically, what you'll see is that COT reports are split up into commercial, non-commercial, reportable, and non-reportable participants. And you'll also see that down the years, so since the mid-80s, the CFTC has actually changed the way in they report their data. So you'll see different definitions in different data sets down the years since the mid-1980s. So again, it can be very, very confusing as to what to focus on here. Basically, in terms of the definitions of market participants that the CFTC reports, generically what we're not interested in is commercial activities. And that's because as traders, we don't glean any useful information or interpretation on our timing from the commercial activity. So commercial activity is primarily corporations, and the activities of these market participants in terms of traders, we can't really take anything useful from it in terms of as an input towards our timing as to whether our timing could be better or if our timing is good. Because commercial activity can simply be commercial producers hedging already long physical positions. So for example, you'll see contracts in the data when you download it for corn, wheat, and the cattle market. Well, if they're agricultural producers, then they will be defined as a market participant as commercial, and their activity could literally be that they're hedging out their corn, wheat, and cattle physical positions. So agricultural producers that actually have physical positions in corn, wheat, and cattle. So we can't really glean any useful information out of that as to whether the market is in our favor or against us, or turning in our favor or turning against us. Now, in the forex market, commercials can also be corporates, and they can also be hedging forex positions. So for example, if a corporate knows that in a month's time they have a liability to pay in Europe, so costs denominated in euros, they may decide to hedge that exposure by buying forward contracts now on euro-dollar. So we can't really glean anything, again, from commercials in forex in terms of our timing. We're also not interested in reportable and non-reportable transactions, because this constitutes market participants such as market makers, dealers, brokers, and also, in addition, retail in an aggregated format. So when we look at market makers, dealers, and brokers, for example, these guys are actually the middlemen, and they're acting on behalf of clients. So what they're reporting is trades where they match buyers and sellers, and also trades that they've transacted on behalf of their clients, so transacted on behalf of buyers and sellers. So again, we can't really glean anything useful in terms of our own timing to our fundamental predispositions from these market participants. And retail in an aggregated format, well, we're trying not to be retail. So we're trying to be institutional, and we're trying to look at a 1 to 3 month time horizon and emulate professional traders and hedge fund managers. So the focus we want to have is on these market participants. What we're interested in is purely in the non-commercial transactions that have been stripped out of all the data, because this constitutes institutional and hedge fund money, and these market participants, what they've been doing in their own trading activity. Now let's have a look at the data and the downloads that we're looking for. If you go to the CFTC website via the links in the previous slide, you'll see quite a few downloads for COT financial futures since the mid-1980s. So you'll see COT financial futures 1986 to 2006. You'll see COT financial futures 2007 to 2014. And you'll see COT financial futures 2015. And this is because since the mid-80s, the CFTC has changed their definitions and breakdowns a few times over the years. So how market participants are defined and how the data is actually broken down in the spreadsheets. So you're going to have a very, very hard job when you download all of this data, actually interpreting it correctly, because you have to find the data in 2015, what the definition of the data of each column was in the prior period 07 to 14, and in the prior period to that 86 to 2006. And this would actually involve you getting in contact with the CFTC. But fortunately, we've already done that, and we've aggregated all the data for you as an example, so we can actually show you what you need to really focus on and also how to interpret it correctly. So let's have a look at what we need to focus on within each of these reports, so we can actually get an aggregated report from 1986 all the way up to present day. When you look at the previous two periods in terms of the definitions, so when we look at 1986 to 2014, you need to be focusing on the historical data within the currency pair that you've chosen, deleting all the columns that are no use and focusing on these 7 columns. So we want the report date as month, month, day, day, year, 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 year. Non-commercial positions, long all. Non-commercial positions, short all. The change in non-commercial longs all. The change in non-commercial shorts all. Percentage of open interest, non-commercial longs all. And the percentage of open interest, non-commercial short all. And as of 2015, the CFTC changed its formats. So we have to line up the data correctly. So from 2015 onwards, we have to take the following 7 columns, which line up with the previous 7 columns that we looked at on the previous slide. So again, we want the report date in this format. We want leveraged money positions, long all. Leveraged money positions, short all. Change in leveraged money, long all. Changed in leveraged money, short all. The percentage of open interest from leveraged money, long all, and the percentage of open interest from leveraged money, short all. So these 7 columns here, by the new definition, are exactly the same definition as the ones before, as in they're coming from non-commercial positions, except now they're calling it leveraged money. So these are the data columns that we have to line up to ensure that we're looking at the same data. So although the names of the definitions are different, the definitions are exactly the same. Now what we can do is go over to the spreadsheets that are available for you in the download section and start to look at this data. So if we come out of the presentation and we head over to our spreadsheet data, you'll see that we've got 4 sheets. So our 3 sheets here, we have the COT financial futures data 1986 to 2006. We have 2007 to 2014, and we have 2015. Now, how do we put all of this data together? Well, let's start with the 1986 to 2006 report. And the 7 columns that we looked at earlier in the presentation, we've actually highlighted these for you on the data downloads. And we've done this in the same way for the 2007 data. So report date and the 6 extra columns that we need to focus on by definition as non-commercials. And then in 2015, non-commercial name as definition changed to leverage money. So we've highlighted these for you as well. Now where you get the contracts, so the contract names is down here. So we're looking here, for example, at the Canadian dollar, the Swiss franc, and the British pound. And what we do is we put all of this data together for these 7 columns, and we've put it into this spreadsheet for you and given them our own names. So we have non-commercial positions long, non-commercial positions short, change in non-commercial positions long, change in non-commercial positions short. And then we've got the percentage of net commercial positions long and the percentage of net commercial positions short. So we put all of this data together in this format for you. Now, if we go back to the presentation, we can start to understand what we actually want to look for here. So in order to know what we're actually looking for and what we want to know, we need to really understand what we're looking at first. What we're looking at when we look at non-commercials is what hedge funds are doing. And what we're interested in is their positioning. Specifically, what we want to know is if they are long or short a currency pair, and by what magnitude, so what their conviction is. So if hedge funds are long, they obviously believe that the currency pair will go up in value. And if they're short, they obviously believe the currency pair will go down in value. And remember, this is real data. These are not numbers that have fallen from the magic fairy tree. They're real. So, of course, if hedge funds are positioned long, they're committed to the belief that the currency will go up and vice versa if they are short. And that's exactly why it's called a commitment of traders report. The hedge funds that we're looking at have been through the same endogenous and exogenous processes as you have to get to this point, to get to the point of having a fundamental predisposition. And if you argue with the market, what's most likely to happen is that you're just going to lose money. So if you get to this stage and there is a big conflict between your fundamental view and the market, what you have to do is actually just put your idea on hold until the timing is better and just continue to update and maintain your fundamental analysis and your spreadsheets. So what does this actually all look like pictorially? Well, the COT reports, when we look at them pictorially, is useful because we can calculate the turning points in positioning and in professional trader or hedge fund sentiment. And we do this by taking the open interest percentage change on both long and short non-commercial or hedge fund positioning and working out the difference between the two. So what we want to do is look at the percentage of open interest of leverage money long on all positions and the percentage of open interest of leveraged money on shorts on all positions. And if we minus the percentage short position from the percentage long position, we get the difference between the percentage of contracts that hedge funds are long and short. So we end up getting the net position of the market, of non-commercials, so of hedge funds. And this creates a new dynamic that is known in professional trading circles as the flip. And the flip basically shows us when hedge funds flip from committing to being net long to committing to being net short, or going from net short to net long. But it also shows us something else. It shows us how committed the commitment actually is. So the rate of change by which positioning is actually changing. And if you go to the download section, you'll see the sheet that we've just taken a brief look at, the Aussie dollar, US dollar COT report. And the chart we're going to look at now is this. So this is how it looks like pictorially. So let's go over to the spreadsheet and we'll have a look at it. So if we navigate out of the presentation and go to the spreadsheet, Aussie dollar, US dollar COT, what we've got here is the Aussie dollar, US dollar data taken from the COT reports going all the way back to 2004. And if we go over to the data areas, you'll see that we've obviously got data from up to the 2014 spreadsheet, so 2007 to 2014, and also from the spreadsheet 1986 to 2006, because we're going back to 2004 here. And going back to the Aussie dollar, US dollar COT report, what we've done is taken the Aussie dollar data from those three spreadsheets, so from present day all the way back to 2004. So we have our non-commercial longs, non-commercial shorts, our change in non-commercial longs, our change in non-commercial shorts, our percentage change in net commercial longs, our percentage change in net commercial shorts, and then we have our flip data and our actual Aussie dollar, US dollar data taken from investing.com/currencies. And you can see when we first look at the date that the dates are going up in weeks. So we have weekly data coming from the CFTC every Friday. And that's for the previous week. So the data that we want to focus on are these four columns here. So the first one we're going to look at is the flip. How do we actually work out the flip or work out the net percentage positioning? Well, we take the percentage net commercial longs and the percentage net commercial shorts, and we minus the short from the long, and we get the flip data, we get the net data. And we can see this is a minus figure. And on the chart here, we have two lines. If we click on the brown line, you'll see that this is referencing column H, which is our net flip position. So our net positioning in the market from hedge funds. So the amount of the percentage contracts that are held long and short by hedge funds, the difference between the percentage held long and short. So this gives us a minus number, which we interpret as hedge funds are short. Hedge funds are net short the Aussie dollar in the financial futures market. So when we click on the green line, we have the Aussie dollar, US dollar data being referenced from column I. So what does this flip actually mean? Well, our flip is on the left-hand side and our Aussie dollar data is on the right-hand side of the chart. So we can see here we have our zero bound. The zero bound is when percentage long positions held by hedge funds and percentage short positions equal each other. So the market is balanced out. Hedge funds are neither net long or net short. We have here the positive bound. So everything above zero, the positive region, where basically it's telling us that hedge funds in this region are net long the Aussie dollar, US dollar. And then in the minus bound, we have our net short positioning. So hedge funds here below zero are net short. Now, just taking a step back before we start really analyzing this data, the definition of the percentage net commercial long and percentage net commercial short, what this lines up to, this data, when we take from the spreadsheets 1986 to 2006 and 2007 to 2014, is the percentage of open interest of non-commercial long all and the percentage of open interest non-commercial short all. And in our 2015 data set, this is equivalent to the data percentage of open interest leverage money long all and percentage of open interest leverage money short all. So it's quite important to get these definitions right when you select the data of the currency pair that you want to be looking at. So again, we take the net position from here and we obtain what we get is the net positioning of hedge funds overall. And you can see this changes over time. So we have negative values throughout history. We have positive values throughout history. And you can see between 2004 to present day that for the vast majority of times, hedge funds have actually been net long the Aussie dollar, US dollar, and quite rarely been short the Aussie dollar, US dollar. You can also see that the Aussie dollar, US dollar exchange rate value really does follow the net positioning of hedge funds in the market. So it's pretty obvious they get it right a lot more times than they get it wrong. And it's because overall, they're taking the professional trader approach. They're using systematic frameworks and taking fundamental positioning over 1 to 3 month time horizons to capture the volatility that we've identified. So when we look at the net position, whether it's long or short, what the flip actually shows us is when the hedge funds actually go from being net short to net long or net long to net short. So we can see here in recent history that the flip actually occurred around this time. So the brown line coming down means hedge funds are going from being long to short when they go through the zero bound. And this actually occurred here. We've highlighted this for you. So it occurred in the weekly data on the 30th of September 2014. And you can see when we look at Aussie dollar, US dollar, that at the same time, it was moving a little bit sideways, and then 1 or 2 weeks later, it fell. It was falling before overall, but it fell after the flip occurred. And this happens repeatedly throughout history. If you want to go through, check the data and reference it pictorially as well. Try to see when the flip occurs, going from zero or below zero to above zero, and from above zero to below zero. And the flip is very significant. The flip always tells us that the hedge fund industry, the hedge fund market overall, is changing their net positioning and their net commitment to a particular currency pair. And when this happens, it's very significant in the forex market, and it sometimes, or most of the time, has a self-fulfilling prophecy in that the market is looking at this data. So the smarter money is looking at this data, and they have their fundamental predispositions beforehand. But when a flip occurs in a currency pair, it's significant because the market will actually start moving into the trades that they want to move into, given their fundamental predispositions. So when the flip occurs, it's pretty significant. It ends up having a self-fulfilling prophecy. Now, the other thing we can look at and reference here is the actual rate of change of the net positioning. So if we look throughout history, we can see that when net positioning gets to around 60 long, so net 60 long, we tend to top out in Aussie dollar, US dollar. So when the hedge fund industry gets long up to this point, where the net positioning is above positive 60, this can signify turning points. And if we look in the negatives, we can see that around minus 35.40 net short, and even down to minus 45, so around minus 40. This is where the momentum of being short in the hedge fund industry throughout history usually runs out and then turns around. We can see this as evidenced throughout the historical COT data and relative to Aussie dollar, US dollar. So what we actually see throughout history is where the net positioning becomes exhausted. So in terms of timing, the COT data gives us a few things. Firstly, it tells us when the flip occurs and the direction the wind is blowing in for the actual currency pair we're looking at from a fundamental perspective, because the fundamental investors and the hedge funds are actually changing their overall positioning. That's what is happening when the flip is occurring. And it also tells us the commitment of the commitment. So it tells us that here at the extremes, the market is so committed to being net short or net long that sentiment can be overly bearish and overly bullish. So we may need to be careful if we're looking to go the same way, or we may need to look at taking a position if we're going the opposite way. So the COT data gives us a lot of information. So go through the spreadsheet in your own time. Practice downloading the data from the CFTC. Build the whole spreadsheet yourself, and you'll see when you look at other currency pairs, you'll probably see a lot of correlation between the COT data and the net positioning of non-commercial players or non-commercial participants. The correlation is very, very high to currency pairs. And obviously, remember and understand how to interpret this data correctly. We have the Aussie dollar, US dollar data here, our currency data, and on the right-hand side, and we have on the left-hand side our net positioning for percentage open interest for the hedge funds. We have our zero bound, so we have our flip bound, so where the flip is occurring, going from net long to net short and net short to net long. And we have our commitment of commitment. So at the extreme positives, we have overly committed longs, and overly committed shorts in the negative extremes. When the longs start falling, the commitment is dropping. When the shorts start falling, the commitment is also dropping. So interpreting this data correctly is pretty important. And one example here, we have the last extreme positive in the Aussie dollar US dollar exchange rate, when we have an above 40 reading on the COT data for net longs. And this was around end of August, beginning of September. And you can see actually this is where it occurred. We've highlighted this for you. The high was 43 net long. So 43% net long in terms of open interest positioning from non-commercials, so hedge fund activity. And then the commitment started dropping. And then 4 weeks later, the flip actually occurred. Then we get to this level down here in the negatives around the low 30s, and then we move sideways. And we've been moving sideways around the 30 level ever since. So we need to bear this in mind when we're thinking of our fundamental predisposition of short Aussie dollar, US dollar, in terms of timing the trade. So download the data, try to work out the correct data, get the spreadsheets set up for yourself, practice how to do this for each currency pair from the data going back to the mid-80s, from the CFTC website. Make sure you put your charts together correctly with your net positioning on the left-hand side, your currency value, exchange rate value on the right-hand side, and chart your COT data for net long or short positioning, open interest percentage positioning, and your currency data correctly, and look for the extremes and look for the flip, and try to interpret the timing correctly. So let's go over to the presentation now and start to try and interpret this timing correctly, and have a look at what we're going to be looking to do in the Aussie dollar US dollar pair. So in order to really understand what we're going to do with our fundamental predisposition of the Aussie dollar short, we have to think again about what this really means. So when the flip occurs, the change either goes positive net long or negative net short. And we've also got those extremes we looked at when the gap between positive and negative sentiment becomes too wide either way. So when we have extreme positive longs minus shorts at or near historical highs, or extreme negative longs minus shorts at or near historical lows, because the extremities can be a warning sign of potential turning points. And what we're trying to highlight here is so you don't make the classic retail trader mistake of looking at a chart and then changing your view. If your fundamental idea, for example, is to go long a currency pair, but you get to the stage of gatekeeping and timing, you're looking at the COT reports and you realize that a positive flip occurred a few months ago and the market positioning is at or near all-time extreme highs. This obviously isn't then a reason to then abandon your entire idea, your fundamental predisposition, and short the currency pair. It literally means only that your timing is off. And you can just wait for the positioning to get to a point where it makes sense to go long. Because doing stuff like this as a trader is honestly one of the stupidest things you'll ever do. Because you've done all the work to have a long fundamental predisposition, and then you pull up one chart and then you're shorting because the chart looks like you should be shorting it. It's honestly one of the dumbest things you'll ever do. And if you were doing this as a professional trader, at a hedge fund or an investment bank, you would literally be fired for that offense. So you've done all your fundamental work, and then you pull up one chart and change your idea. Just doesn't make any sense whatsoever. And especially if you go and lose money when you do that, it's not going to be a very good feeling to have been right fundamentally, but lose money because you went in the opposite direction because the chart convinced you short term to go the other way. It's the stupidest thing you'll ever do. And obviously we were using the example there of a long fundamental predisposition and then shorting because of a chart. It obviously works the same when we have a short fundamental predisposition and then we go long because of a chart. So the opposite holds true. In the Institute, we're obviously going to be pretty annoyed with people punting on COT reports. So doing this the other way round. So only looking at COT reports and not understanding the fundamentals behind the actual trade ideas. So building out your fundamental predispositions first, and then looking at things like COT reports, technical analysis and price action as a timing instrument, not as an instrument that gives you ideas. The COT report doesn't give you fundamental ideas. It gives you a snapshot of whether the market is on your side or against you through the extreme historical moves and through the flip. Because if you just punt on COT reports, for example, or technical analysis and price action, so just looking at charts, a piece of economic data can come out that changes all the fundamentals and changes everything. And it's the most important thing. You need to understand the fundamentals of a country and its currency. Earlier we stated that it's 80% of everything you do, and gatekeeping, risk management is 20%. So a fundamental split of 80-20, so in the favor of fundamentals, and 20 in the minority, technicals, and overlaid with risk management. It's the majority of everything you'll do as a trader if you're taking the professional approach. And it's hard work, but it does pay off. Now, with our potential trade idea to short the Aussie dollar, US dollar, our timing does look off when we look at the COT data, so the net positioning. The market is very short historically. If we stay patient, we're more than likely going to get the opportunity to short it into a rally. So we can sit back and wait for Aussie dollar, US dollar to rally and look for better entry points to short the currency pair. And in the meantime, we can continue to update our spreadsheets, stay on top of the fundamentals, and pick it off when it looks like Aussie dollar, US dollar is at a great level to short in terms of timing. Now, this is another reason why we chose the Aussie dollar, US dollar as an example for the video series, because it's got the volatility that we look for. We have a fundamental predisposition subject to the endo analysis that you're going to do yourself, but the timing according to the COT data is actually off. So this is a great example because when we go through the whole process, it can show you that sometimes you're going to have a fundamental predisposition on currency pairs, and then you're going to start looking to time the trades and time your entries by going through the gatekeeping process. You can pull up the COT data and realize that it's dangerous. You can realize at this stage that you're actually late to the trade. So now you have to just continue to update your spreadsheets, stay on top of the fundamentals, and wait for better timing. So there's a lot of lessons to learn there by looking at the commitment of traders reports. Let's go back over to the trading desk for a quick recap. Okay, so welcome back to the desk. We went through, obviously, there the gatekeeping process, introduced you to a few new ideas, and also went through the commitment of traders reports. So the first thing we did, we wanted to really cement this understanding of the actual gatekeeping process being this barrier that you put between your fundamental ideas that are generated through the idea generation process and your actual capital. And the reason, or the main reasons why we actually have this, is because at this stage an idea is just an idea. It's not actually a trade. Because when you deploy capital, then it becomes a trade. So we have this process, the gatekeeping process, to stop us basically doing one of two things or both at any one time. Basically either putting on good ideas that are badly timed and then we end up losing money when we should have made money, or just putting on bad ideas that just lose money straight away and we're giving money away for no apparent reason. Because a good trade is a good idea that's timed well. So we need to really understand the reasons why we have this and the reasons why we take our time and we try to look for optimal entry points through the gatekeeping process to our ideas that have come out of our idea generation process. Now, the second thing we looked at, we started introducing you to some risk management metrics. Now, we're going to go on to risk management a bit later and go into a bit more detail, but essentially what we looked at there was an overall portfolio with currencies and stocks with gross exposures and exposures to currencies and exposures to stocks. Now, it's a theoretical portfolio at the moment. What's important is the metrics that we're looking at in terms of restricting ourselves on exposure and leverage. So if this was a combination of a stock portfolio and currency portfolio, the gross exposure is 200,000, and we looked at exposure in stocks of 100 and exposures in currencies of 100, and overall being 8 times leveraged and restricting ourselves to that, and having $25,000 deposited on margin in the portfolio, so in the brokerage account. So having the 25k in and having the 200k exposure is the metric that we really want to concentrate on, because whether that's stocks or currencies by themselves or stocks and currencies combined, it doesn't really matter. What we really want to be understanding at this stage is the principle of using a lot less leverage and still getting very high percentage returns on our capital. So we looked at the 8 times overall gross exposure. If we had simple currencies exposure, it can be anything between 4 to 8 times. If we had stock and currencies exposure, stocks would be probably 100k plus 100k currencies. And when we look at currencies alone or currencies within a stock portfolio, the same principles apply when we're trading this asset class as to when we're trading other asset classes. We're a gatekeeper to our capital and we stop ourselves doing stupid things, and we have sensible risk management metrics. We introduce you there also to this concept of having a starter position. And that's important as we move through the gatekeeping process and how we're explaining things work. You need to understand this concept of a starter position. A starter position is when you look at your own portfolio and you decide what your gross exposure limit is in your portfolio, so the maximum exposure you'll go up to, and then you look at a single asset position limit within your overall portfolio. And if, let's say, your overall gross exposure limit that you put on yourself is 200,000 and your currencies exposure is 100,000, then you may decide that your starter position size is 50,000, so half your full position size. And that concept is important because, again, when you have a gatekeeping process, one of the reasons why we're having it is so we have this mechanism in place that stops us doing stupid things. So putting on a good idea that is mistimed and we lose money, and then it ends up becoming a good trade, which is the cardinal sin and the worst feeling in the world in trading, or just putting on a bad trade, losing money and giving money away for no reason. So putting on an idea straight away. If we put on an idea on straight away, we've not even looked at timing it optimally. So getting used to this idea is quite important. The next thing we looked at was COT reports, so the commitment of traders reports. They're very, very useful. We looked at the downloads from the CFTC website. They're really useful as a weekly indicator for figuring out if the timing on our trades is optimal or not. So we have our fundamental predisposition, and we're using the COT reports to decide whether we should be going in with a full position, a starter position, or no position at all, refusing to trade, no trade. And this idea of having a starter position, if we go back to that for a moment, in the context of a commitment of traders report, this idea of having a starter position is just the idea of being in the game. So you have a fundamental position, but you know you don't want to fully commit to it. You want to leave some ammunition. So let's say, for example, the commitment of traders reports, you see the flip has just occurred in the last couple of weeks, and your fundamental predisposition is to be short the currency pair, and the flip has come in positive. Well, you might decide that because the flip has occurred, it's not near historical lows, it's not near historical highs, that you might play with the idea of having a smaller position than your maximum position size, and it might become a starter position. So what that is actually doing, the commitment of traders report in this respect, is stopping you from putting on a full position. So stopping you again from doing something stupid, because you could put on the full position, it could end up being a good trade longer term, but in the short term, because of the flip, it might go straight up in your face and you get stopped out in the next 1 to 2 weeks, and you lose money, and then 3 months later the currency pair is down and you would have made money, but you've been stopped out. So in that respect, the COT report explains how a starter position works and what it's there for. So when we look at technical analysis and price action later, we do this in a bit more detail. But the concept to get hold of now is that in terms of timing, why we're using these things is firstly to stop us doing stupid things, but also to have some sort of subjectivity in our position sizing and working out as much as what not to do as to what we should be doing. So for example, if you have a trade idea, you obviously think it's going to be a great idea, and you just put this barrier between your idea and your real capital. You bring up the technical indicators, like the COT reports, like technical analysis, like price action, and you monitor the potential or optimal timing of taking the idea from an idea to a trade and ending up with a real position. If the technical indicators tell you it's not the right timing, then the technical indicators are telling you to not do something. They're telling you to not put the position on and that you'd be better off waiting. But the opposite might happen. The opposite may happen as in they tell you you should go for it. You should actually go into the trade now and put on a almost full position size or full position size straight away. But something might happen somewhere in the middle. You might not be fully convinced, but you might not want to be in the game. So there's always the option to have a starter position and add to the position later as the technical indicators show you that the timing is going to be better. So the COT report is one of these great examples of cleansing your idea within the gatekeeping process. We can use it to time trades better with our fundamental predispositions. If we combine this with technical analysis and monitoring price action, we're going to add a lot of value to our overall process and save ourselves a lot of money over our lifetime by not mistiming trades or getting in to bad trades full stop. So now we're going to move over to technical analysis. Practice your COP report on the spreadsheet, download the data, go to the download section and practice building the spreadsheet that we showed you, and do it for other currencies, do it for other currency pairs, and you'll see that it's an extremely useful indicator in terms of timing. But never forget that that's what it's there for. It doesn't produce ideas. We're not here to just copy what people are doing. We're here to put the COT reports, technical analysis, and price action monitoring within a timing mechanism that cleanses our ideas. So we enter the trades that we want to enter from a fundamental perspective, but we just time them better because we've got the market on our side. So go through, practice, and I'll see you in the next video on technical analysis.